Picture this. The year is 2000. You are sitting inside a massive, hyper-modern corporate boardroom in Dallas, Texas. The air conditioning is absolutely freezing, but the tension in the room, it is so thick, it's making everyone sweat. At one end of this giant mahogany table, you have the sharply dressed executives of a seemingly invincible, dominant retail empire. And sitting right across from them at the other end is a ragtag, exhausted group of startup founders. This tiny startup is in deep trouble. They are burning through cash at an alarming rate, literally bleeding out money. They are so desperate that they've flown halfway across the country on a chartered flight just to beg this corporate titan for a $50 million lifeline. It is their ultimate Hail Mary pass to save their dying company. The startup founders make their pitch. The massive $50 million number is dropped onto the table. And then, nothing. Just complete, dead silence.
So what actually happens when you ask a corporate behemoth for $50 million and they just stare at you blankly? Well, you have to understand, this wasn't just your standard run-of-the-mill business meeting. This was a brutal, incredibly awkward culture clash. On one side of the table, you have these exhausted startup founders who literally showed up to this high-stakes, multi-million-dollar meeting wearing t-shirts, shorts, and flip-flops, all because they had just come straight from a company retreat. And on the other side, you have the strictly professional, suit-and-tie executive board of a retail giant that operates over 9,000 physical stores worldwide. The guys in the flip-flops are pitching this wildly speculative, unheard-of online model. They are essentially asking this massive physical retail giant to just buy them out and let them handle the internet side of the business. The executives listen, they look at the flip-flops, they look at the horrific, bleeding balance sheet of this little startup, and they offer absolutely nothing but a dead, unblinking stare.
The contrast between these two players is the ultimate David and Goliath scenario, but with real money on the line. On the left side, we have our scrappy startup. They have a massive dream. They have some really smart software. But financially, they are entirely on life support. They are absolutely desperate for capital just to keep the lights on for another few months. On the right side, we have Goliath. And we aren't just talking about a big company. We are talking about a company that controls an $8.4 billion global empire. They are the undisputed kings of their industry. They are so powerful, they literally dictate terms to Hollywood studios. They have millions upon millions of regular, paying, loyal customers. For the executives representing the giant, $50 million is literally a rounding error. But to hand it over to these desperate guys in shorts, the financial tension in that room was suffocating.
Okay, let's finally dive into this and name some names, because the reveal is crazy. That $8.4 billion giant sitting at the table, that was Blockbuster Video. And that desperate, bleeding startup sweating in their flip-flops, that was Netflix. To really grasp this, look at how dominant Blockbuster was leading up to this fateful meeting in 2000. They opened their very first store in Dallas back in 1985. By 1987, thanks to the aggressive expansion model of Wayne Huizinga, they were opening a brand new store every 24 hours. Fast forward to 1994, and the giant media conglomerate Viacom acquires them for a staggering $8.4 billion. So when Netflix founders Reed Hastings and Mark Randolph walked into that room in 2000, they were walking straight into the belly of the absolute biggest beast in entertainment.
To truly understand the insane power dynamic here and the sheer terrifying scale of it all, we have to talk about this number right here, 9,094. That is exactly how many physical stores Blockbuster operated at its absolute peak. They employed over 84,000 people globally. They were so big, they were practically a public utility for entertainment. Think about it. If you wanted to watch a movie on a Friday night, you went to Blockbuster, no questions asked. They had absolute, unchallenged market dominance, incredible cash flow, and a deeply ingrained brand presence in literally almost every neighborhood in America. Meanwhile, Netflix, at this exact same time, was this tiny, struggling DVD-by-mail service that most people had never even heard of.
And this brings us to the famous David versus Goliath myth and how we generally remember this boardroom battle today. Because of what eventually happened in the market, this specific meeting has gone down in corporate folklore. It has become the ultimate business fable. It's taught in business schools, it's repeated in boardrooms all over the world. But here's the crazy part. The way we remember this story is wildly, completely different from the actual, complex financial reality of what happened. According to the popular legend, the Blockbuster executives, and specifically their CEO, John Antioco, arrogantly laughed the Netflix founders right out of the room. They supposedly just chuckled at the very idea of this struggling internet company asking them for $50 million. The The story goes that Hastings and Randolph got back on their charter flight feeling absolutely humiliated and defeated. But as they slouched in their seats, Mark Randolph turned to his partner and delivered a line dripping with pure defiance. He said, "Now we're going to have to kick their ass." I mean, it is the perfect cinematic underdog story, right? The arrogant giant ignores the scrappy heroes, who then vow revenge and eventually destroy the giant. It is a fantastic script. But guys, it's just that, a script. The cold, hard business reality completely shatters that comfortable myth. Let's break this down. First of all, Blockbuster CEO John Antioco likely wasn't even in that specific meeting, or if he was, he only popped his head in briefly. Second, Blockbuster couldn't just magically write a $50 million check on a whim anyway. They were owned by Viacom, which meant any major acquisition required massive corporate red tape and boardroom approval. But most importantly, from a pure, objective financial perspective, the deal Netflix offered was just terrible. Netflix was losing money hand over fist. Blockbuster knew they could easily build their own website for a tiny fraction of that $50 million. Buying the cash-burning startup just didn't make any financial sense to a company structured around highly profitable physical retail margins.
So, if the reality is so different, why do we all believe the myth? Why is the story of the laughing CEO repeated so often by so many smart people? It all comes down to a really fascinating psychological concept known as availability bias. As humans, we just love simple, easy-to-remember narratives. A story about an arrogant Goliath being slain by a brilliant David is exciting. It's deeply satisfying. It is so much easier for our brains to digest than the actual truth, which involves complex corporate governance, Viacom's acquisition strategies, boring unit economics, and deep cash flow analysis. We fell for the Netflix myth because it feels good, while the boring reality of corporate finance gets quietly swept under the rug.
And that brings us to this absolutely brilliant quote from the famous physicist Richard Feynman. He said, "The first principle is that you must not fool yourself, and you are the easiest person to fool." If we are really going to understand the true financial history of why Blockbuster collapsed, we have to stop fooling ourselves with that fun underdog myth. Netflix did not just wave a magic wand and instantly destroy Blockbuster. In fact, Blockbuster's death had very, very little to do with Netflix's initial success. To find the real killer, we have to look away from Silicon Valley and look deep inside Blockbuster's own boardroom.
So who was the real killer? Well, it was a toxic combination of vicious internal wars, massive crushing debt, and the death of a program called Total Access. This is exactly where the story shifts from a cute fairy tale to a mature, high-stakes financial thriller. Because the truth is, Blockbuster was murdered from the inside. It was a brutal corporate civil war over strategy, compounded by an inescapable mountain of debt that actually signed the company's death warrant.
Let's actually clear John Antioco's name for a second here. The Blockbuster CEO was not asleep at the wheel like everyone says. When Netflix finally started gaining real, threatening traction with their DVD by mail service, Antioco didn't just ignore them. He launched a massive billion-dollar counterattack called Total Access. And it was an incredibly aggressive program. Customers could rent a DVD online, have it mailed to them, and then, and this was the absolute genius part, they could return that DVD to a physical Blockbuster store and get a brand new movie for free right there on the spot. Netflix literally could not compete with that instant gratification. Antioco was actually winning. Total Access was a massive consumer success. Subscribers were flooding in, and Netflix's growth actually started to panic.
But here is the massive, fatal flaw in that brilliant plan. $2. Every single time a Total Access customer swapped a movie in-store for free, it cost Blockbuster $2 in lost rental revenue and operational overhead. Antioco was essentially subsidizing the destruction of Netflix out of his own company's pocket. The strategy was to purposefully bleed money in the short term to completely crush Netflix, acquire massive market share, and figure out the profits later. But here's the thing, Wall Street hates bleeding. This brilliant consumer counterattack was acting as a massive financial black hole, completely draining Blockbuster's quarterly profits. This massive cash burn triggered an incredibly destructive boardroom proxy fight. It was a complete civil war. On one side, you have CEO John Antioco. His plan was to scrap late fees, invest heavily in the online platform, and absorb massive financial losses just to fight Netflix to the death. On the exact opposite side was the notorious billionaire financier Carl Icahn, who had aggressively bought his way onto Blockbuster's board. Icahn's plan? Stop the financial bleeding immediately, kill the wildly expensive Total Access program, restore immediate profitability, and sell the company off to private equity. It was a classic, brutal clash between long-term strategic survival and short-term financial engineering.
And here is exactly how this internal war handed the entire market back to Netflix on a silver platter. Step 1. Carl Icahn leverages Wall Street's anger over the falling profits to wage a massive proxy war, specifically attacking Antioco's massive compensation package. The pressure works. By 2007, Antioco is successfully pushed out of the company. Next, Carl Icahn brings in a brand new CEO, James Keyes. Keyes immediately acts on Icahn's mandate. He kills the free movie deal in total access and raises online rental prices to stop the cash burn. And the result? Blockbuster's online growth instantly dies. The exact moment they stopped fighting, Netflix caught their breath, regained their momentum, and literally never looked back.
But the bad decisions certainly didn't stop with killing their absolute best weapon. Blockbuster's management was frantically making desperate financial gambles as their core physical rental business began to decay around them. Just look at this insane list of capital misallocations. In 2000, they partnered with Enron, yes, that Enron, to create a broadband network, a deal that obviously collapsed entirely. They wasted precious time and capital trying to execute a hostile takeover of their main rival Hollywood Video, which ended up being blocked by regulators. In 2008, in a move that completely baffled financial analysts, they tried to buy out Circuit City, an electronics retailer that was itself already heading for bankruptcy. And finally, under James Keyes, they essentially abandoned the entire online DVD market to refocus entirely on retail stores and late fees. They were literally rearranging deck chairs on the Titanic.
The final absolute nail in the coffin was the balance sheet. By 2010, the numbers were grim. Operating income was negative $78.8 million. Net income was a staggering negative $268 million. But the absolute killer, the thing they could not escape, was their total debt, $900 million. Blockbuster wasn't just losing money, they were suffocating under leverage. They owed nearly $1 billion to bondholders and lenders, and their physical stores were no longer generating the massive cash flow needed to even service that interest. The internal wars and those desperate acquisitions had left the balance sheet completely and utterly ruined.
The end came swiftly and, honestly, tragically. In September 2010, completely crushed by that $900 million debt load, Blockbuster officially filed for Chapter 11 bankruptcy protection. They tried to reorganize, but it was just far too late. In 2011, Dish Network scooped up the remaining assets in a bankruptcy auction for a mere $320 million. Now put that into perspective, that is a tiny fraction of the $8.4 billion Viacom had paid a decade earlier. Dish tried to keep some stores open, but the physical rental market was dead. By January 2014, Dish permanently shut down all 300 of the remaining corporate-owned Blockbuster stores. The multi-billion-dollar empire was fully liquidated and sold for parts.
Which brings us to a rather sobering number today. 1. Out of the 9,094 global locations that once completely ruled the entertainment world, only a single stubborn franchise store remains open today. It's operating as a quirky tourist attraction in Bend, Oregon. It stands as a solitary tombstone for a company that once employed over 84,000 people.
So as we wrap up this explainer, I really want to leave you with this final thought. Does history remember the cold, complex financial truth, or do we just remember the most entertaining story? We all love the myth of the arrogant executives laughing at the startup kids in flip-flops. It's a great tale. But as we've uncovered today, Blockbuster wasn't killed by an arrogant laugh. They were killed by unit economics, a brutal boardroom proxy war with an activist investor, massive debt, and a failure to stick to a winning strategy. As focused learners, it is our job to look past these romanticized corporate fables, dig deep into the actual numbers, and find the real truth driving the business. Because in the end, it's never the story that bankrupts a company, it's the balance sheet.